Welcome to the Wealth Wisdom Podcast. I'm your host, John Lawson, Senior Wealth Advisor at Asante Capital Management and Sana Family Office. We're always looking for unique ways to educate our client families and be introduced to new clients. At Sana Family Office, we help business owners and affluent families navigate the complexities of wealth through a variety of wealth management and family enterprise oversight services. Today, we're speaking with Bob Swanson, Senior Vice President and Co-Head of Equities and Portfolio Management at CI Global Asset Management. Bob is a seasoned professional with over 40 years in investment management and a perfect guest to guide us through a recap of last year and to gaze into that crystal ball for what to expect in 2024. Welcome, Bob, and thank you for being our guest today. Quick question first, where in the world are you today?
Today, I am in Boston, which is where our office has always been. And I know most everybody else has been relocated and in Toronto and elsewhere, but I've always been since I've been at CI, I've always been in our Boston office, although I spent the vast majority of my time in Canada, but this is where I am today.
And the big question, because we on the West Coast are a little finicky about our weather, what's it like there in Boston for you?
It's pretty miserable. And the wind and the rain and then the temperatures drop. So we're not quite as bone chilling as I've seen out west, but it's coming. It's been migrating further east, and so I know we've got some colder days ahead of us. So crazy weather patterns all throughout the continent, and I think there's more to come with that regard.
All right. Well, we'll just keep the heat up and get on with our show today. So as we talked about, what we're really looking for is kind of past, present, and future of the global equity markets from you. So markets, both stocks and bonds, ended up being in investors' favor by the end of 2023. Some people said it was a great year in the last 2 months. Were you surprised by the year-end returns or surprised how we got there?
Yeah, I would say I was surprised how we got there. I mean, it's funny because we're doing our year-end or year forward-looking analysis now. But a year ago, when we were having these conversations, it was we were thinking the Fed was going to begin easing, and that the markets would renormalize in the first half of the year, and smooth out for the remainder of the year. Of course, none of that occurred. The Fed continued and the central banks continued to tighten rates and beyond what everybody expected. And we didn't get the rate cuts and weighed heavily on the market until really the final 2 months, the final 6 weeks of the year, when again, the expectations for additional rate cuts became the current thinking, and you saw the markets respond to that. So it's I think last year took most investors a little bit by surprise. Certainly the strong finish was welcome, but not widely anticipated.
Yeah. And in that mix and what happened with all the different tug of war of emotions going on, what's been referred to as the Magnificent Seven were a big part of that story. Will and can that trend continue? And how does AI factor into those stocks?
Yeah, I would say Magnificent Seven was like the only story for the vast majority of the year last year. In fact, it was, throughout various points in time, we had the market down and those stocks up strongly. And so there was a huge bifurcation in the overall market. And that really persisted until probably December, maybe even the last couple of weeks of the year. So can it continue? I think the big seven are still going to be dominant forces in the marketplace. As you said, a lot of it was AI related, and I think AI is going to continue to be a big story into 2024 and likely beyond. But I don't think the magnitude that we had from the contribution we saw from those seven will be, nearly the magnitude that we had in the last year. I think what we're going to see is a little more broadening out of the marketplace. Some of those stocks obviously had tremendous performers as a group. They are up, almost triple digits. And I think what we're going to see this year is a little more normalization within the marketplace. They're not going away. They're still there. There's still factors. AI is still there. But we're beginning to see more and more players come into AI. We're beginning to see those applications spread out a little bit. The supply chain problems that we experienced forced, some people into a few players, like NVIDIA, for instance. If you listen to NVIDIA, their books are full for 2024, so they're done. So if you want, if you're looking to get more access to AI, you're going to have to go elsewhere and find other vendors and suppliers for some of those services, software, chip services. And I think that's what we'll see this year. Is it'll broaden out into a wider distribution of providers of those inputs and services for AI. So the result of that is, yes, they're still there. They're still going to be important in the marketplace, but I think their role is going to diminish a little bit relative to everybody else. And we should see a little bit more broadening of the marketplace throughout this year.
Okay, so two things I think I hear that you're saying there is there's two pieces to AI. One is those that drive the AI and in terms of the making it possible. And then there are the others that utilize AI to create efficiencies within their business.
Yeah, and I think that's where the big opportunity is coming from. And initially, people looked at the big platforms. They said, who has a platform of users that could use it? So, a Facebook type of company where they've got a huge database and a huge clientele. What could they do? What efficiencies could they gain, and how could they optimize their platform utilizing AI? But I think we will spread out and beyond that into it's certainly more sectors, more companies in the marketplace. And again, because everybody's looking for it, and there has been a dearth of supply of that, which is why those handful of companies did so well. We are going to see other participants enter the arena here, and I think that provides a broader set of opportunities.
Yeah, and that's par for the course. History tells us you open something up, and that makes opportunity for lots of people, and sometimes people come out and surprise you. Well, I mean, if we go back last couple of years, NVIDIA was one of those that came out of nowhere, so to speak.
Right.
What about, I think the second thing that I heard you say in there is that what you're looking more for is, yes, the big seven, the magnificent seven, they're going to be there, and they'll probably continue to perform, not at the same pace, but it's much more of they left the rest of the market behind. So the good companies in that broad market, you're looking for them to catch up.
Yeah, absolutely. This reminds me a little bit, John, of 1999, 2000, as as Y2K was coming. And remember back then it was Cisco. Cisco was the NVIDIA of today. And everybody was jamming into a handful of stocks. And those stocks had fantastic performance, excuse me, and the rest of the market languished. But what we saw post, 2000, once we got into 2000, we saw a broadening of the marketplace. Those big leaders kind of faded off into the sunset a little bit. In fact, Cisco, may not. I mean, it's been sort of away for a couple of decades now. And we saw small caps. We saw the rest of the S&P, the other 495 companies, and in this case, 493 companies, did a lot better. And so we saw performance, the breadth of performance improved tremendously. And so, we just saw many more participants, and the big winners of the prior couple of years just sort of faded in terms of importance. And the big returns were made elsewhere in the marketplace. And I suspect we're going to see a bit of a repeat. It doesn't repeat, history doesn't repeat identically, right? But it rhymes. And what we saw this year, even if you look at the equal weighted S&P 500 versus the cap weighted S&P, which is dominated by those seven companies, the performance differential was huge. It was a 2 standard deviation event, just a tremendous difference. And I suspect we're beginning to see a little bit of a mean reversion. We'll see the rest of the they don't necessarily have to pull back, but the rest of the market will catch up relative to where they've been. So, that I would, it feels like the market's already beginning to sort that out and head that direction, at least for the first couple of weeks anyway here.
Yeah, first couple of weeks don't make a year. We've learned that.
No, that's for sure. We've learned that many times over.
To your point, going back to 1999, I remember it well, and everybody was chasing that .com side, and they just talked about the end of bricks and mortar, and the big one that I remember is just here in Canada specifically, but it was North America. Um, they hated banks.
Yeah.
Yet banks weren't making any less money.
Right.
It just, they weren't the hot thing. And then in 2000, when the market caved, we actually did really well because we were more diversified out and had a good holding in banks, and we did really well. So
Yeah.
similar, I think, is what you're saying.
I would agree with you there, John.
Yeah.
Yeah.
Yeah. So we've touched on it a little bit, but what other areas in the global markets do you see promise? And the flip side of that question, maybe some reason for caution.
Yeah. So let's start with the S&P 500. Like I said, I think the other 493 hold promise to do well. And, for, like I said, for vast majority of 2023, a lot of those stocks were in negative territory and finally started to come alive at the end of the year. So I think there's probably a little bit of there's a catch-up trade there. And maybe investors focus, get away from those seven and begin to look elsewhere. Um, as I said, we're beginning to see it. Look at GE. I mean, GE, originally I said, it's your father's stock. No, it's your grandfather's stock, and IBM. Look at the performance of IBM and GE and some of these, companies that have been long gone, or so you thought, and all of a sudden, they're coming back into favor with the investors. So I do think it's already beginning to happen where we're seeing other segments of the market, small caps, both in the U.S. and Canada, massive underperformers these last several years. And similar to, post 2000, small caps did well in that subsequent time frame as well. So I just think that the valuation discounts for a lot of these companies have really been depressed because people have just completely exited them. There's been no interest in the space for such a long time. So I think where there's been, that void of interest that begins to create the opportunity. But there's also, if we start with the bigger picture and say, okay, I think, let's call it the equal weighted or the rest of the S&P, the small cap market in the US. If you go into Europe, I think everybody's been shying away from Europe, certainly for the last couple of years. But the European markets did actually very well last year. I mean, they held up quite nicely. The area that I looking at and seeing promise and been adding to is Japan. Japan, the last time people were interested in Japan was probably when the Japanese investors bought Pebble Beach Golf Course back in 1990 or whenever it was, right? I mean, that was the peak of the Japanese market, and nobody's been there for 3 decades now. So, but there's been some transformational things taking place and structural changes in Japan with regard to what they want to do with their companies in order to get into various indices. And companies are beginning to focus on profitability, and it's, of course, that wasn't part of the culture before. And so now you've got a segment of the companies that are looking at returns and profitability, and they're incredibly cheap relative to those attributes, as compared to the rest of the world. So I think there's some opportunities there, but there's also within, you always say that it's a collection of stocks. It's not the market. The S&P, the performance of the S&P really wasn't the S&P. It was a handful of companies. So when you look at the segments of each of those markets, there's opportunities within, lots of opportunities. Think of the big underperformers last year: telecom, utilities, the telecoms. Verizon, AT&T, even TELUS in Canada. Big underperformers, and I think there's some opportunity there. A lot of the spending cycles are behind them, and now it's time for them to generate some cash flow and do something productive with it. So there's opportunities in those segments. Another big story last year were the diabetes, weight loss drugs, the GLP-1 drugs we talked about, Novo Nordisk overseas, Eli Lilly in the States. Look at the rest of the healthcare space, did nothing. The rest of the pharmaceuticals were negative for the most part on the year. So as we look at these things, there's companies that are actually doing a good job and are growing, but they weren't the hot stock. And so everybody just left him and went into, and, clamored into, the big story stocks. And that has created really a lot of opportunities in many various segments of the marketplace, not only within, the US and Canada, abroad, sectors, countries we hadn't paid attention to much, like Japan. And, so I think that's where the opportunity is. You mentioned risks. Of course, there's risk with all this. The risk is there's a couple of, there's the geopolitical risk, which if the tensions continue, of course we've got the wars going on, and the tragedies and atrocities associated with that. The geopolitical risk, certainly between the US and China, and restricting technology and the trading of technology and the bifurcation of companies there. Those are big risks that can derail this whole globalization theme that has been building and accumulating for the past several decades. So is there a risk that we become more nationalistic as opposed to global in our trade? And what would that suggest? There's a big risk with that. I would say that's, we don't talk a lot about it, but I think the geopolitical risks are heating up, and it's beginning to impact trade and those relationships. And if that continues, that could really derail a lot of investment theses that I just discussed, moving into these other areas. So that would certainly be a concern. And I think China, last year when we started the year, I think everybody was kind of thinking, okay, China was slow in coming out of COVID. Remember, they were more restricted with their COVID policies, and then they began to ease a little bit, but not like the rest of the world. And everybody thought 2023 was the year that China was going to, kind of regain its footing and gain some traction. Did not happen. And so that continues to be a risk into 2024. If China continues to decline or slow down, as we've been seeing, that's going to weigh on global economics and global trade as well. So that's another issue that, we've got to pay attention to. Certainly optimistic that the policy changes we're beginning to see out of China will gain some traction, and we'll see a bit of recovery. But right now, the trends don't support that. And so that's something we have to, you've got to keep in the back of your head that there could be ongoing problems there, that maybe they don't turn it around as quickly as anticipated.
Right. All right. Okay, so then I've got to ask the big question that so many clients are bringing up with me, and we're likely to hear, we know this is a given, a lot more noise regarding the U.S. elections, and I do categorize it as noise, but we also can't ignore the fact, at least in the short term, it affects markets because of the emotional swings that it can create. Your thoughts?
Yeah, I agree with you, John. I think, as I think back over the last couple of decades, there's been a number of what I call abnormal environments. We had, the Y2K in 2000, and then we had the great financial crisis in 2008. And then the Fed came in and central bankers, and they took unusual policies. And so that was very disruptive and changed the way investments happen, really, the way people think about investing. And then we had the COVID cycle, and same thing with COVID, the world shut down, and then it gets flooded with liquidity and reopens up, and too much growth and all this stuff. And I scribbled into my notes that, one of the other abnormalities that occurred between the GFC and COVID was Trump. And, becoming president. I mean, it shook everything up. And to this day, it's going to continue to shake things up, right? So he just had a good showing in the Iowa caucus last night. So he's the front runner for the Republican nomination. And, that just brings with it a whole litany of things that could roil the markets and bring, volatility along with it. And so I agree wholeheartedly with you. I mean, this is something that can just add disruption to the market. Of course, he's disruptive in the way he approaches things, of course, and his commentary and what he does for geopolitical tensions and how he's going to handle conflict. And that can definitely ruffle the markets. And I would suspect we're in for some volatile times as we, for the next 11 months as we approach election season, 10 months as we get into election season. So I would agree that's going to be there. But it's also going to be there post-election in all likelihood. So, even once there's a new president elected, depending on is it, Trump or Biden or somebody else, there's going to be, what does that mean for policy development and such. So yes, there's going to be volatility associated with, is any of it structural remains to be seen. Big, tax cuts, could are going to influence things and policy changes, but most of it is noise. But that noise creates a lot of consternation with investors and adds to volatile markets. So that's the unfortunate part. But we've been dealing with some crazy times the last couple of decades, and maybe it's always been that way, I suppose. In 1987 we had the big crash and whatever. So there's always something, and that comes along. So it's just add it to the repertoire of things to be concerned with. What we have to deal with from a risk management perspective as we structure and manage our portfolios.
Yeah, a colleague of ours in the U.S., Nick Murray, love his comment or quote. He calls it the apocalypse du jour. There's every day there's something that somebody says is going to end the world, but miraculously,
we're still here.
We tend to move forward and do well. And it really does go same thing with elections, whether it's in Canada, whether it's in the States or different countries in the world. It's disruptive at times, but there's always new opportunities that come out of it. So it's just a matter of staying on the ball and seeing what's going to benefit from the changes.
Yeah. It's very interesting because one of the things I've been thinking of, John, is that time. People don't talk about time, but corporations or CEOs, they have, if given the amount of sufficient time, they can change the way they do things. We as investors, if given enough time, we can restructure the portfolios or how we're positioning ourselves. You can do the same thing with your clients if given enough time. And over time, you tend to get the wiggles out and you're back on track. And we've had a lot of dislocations just in the last 3 years, but I've said we've also had time. Now we've had 3 years elapse for this, and people have been able to understand how to adapt to these changes and the challenges that they face, and are making changes to counteract that or to optimize or take the opportunity, given that disruption. So time is an important healer, and I think it will be for the markets as well. And so as we work through all these dislocations that we've had, given enough time, we get back on that trend line. And I think I'm going to say it feels like 2024 is going to be one of those years where we get back on trend and get things moving. Of course, the election noise is will be ever present, but everything else we've had enough time to deal with. We had enough time to deal with the low interest rates being lower. We've had time to deal with interest rates being raised. We've had time with interest rates normal. Now we get back on track. Let's get back to the game of investing.
Outstanding. Okay, so then when we're sitting here a year from now, what are we going to be talking about?
Well, we'll still be talking about the elections, unfortunately, a year from now, I think, but that'll still be there. What I hope we're not talking about is greater financial, geopolitical turmoil, and I hope that's not part of it, and further bifurcation and of just individual behaviors. I mean, it's certainly in the States and elsewhere, it's becoming so polarized. I'm hoping that those aren't the big topics next year. What I'm hoping is that we're discussing, sort of the return to normalcy. That the central banks have come in, they've normalized interest rates, and okay, I get it. Like I don't know how I didn't know how to think with 0% interest rates. I didn't know how to value I didn't know how to value a bond or a stock when interest rates are negative. Like That was just completely foreign to me. Now, 4 or 5%, I get it. I'm comfortable with that. It makes sense. I can add up the subcomponents and come up to 4 or 5%. Equity valuations have gone from 20 to 30 or 29, 30 times, back down to that 15 to 20 range. A lot of companies, the vast majority of them, are back to their normal range. So we've normalized interest rates, we've normalized equity valuations, with the exception of a few of them. So things are getting back into normal. And I certainly hope by the end of next year, what we're saying, we're going to look back in the rearview mirror and say, you know what, that was like, again, that was a perfectly normal year. Stocks did 8 to 10%. Bonds, you got 4, 5, 6% return out of your bonds. Balanced portfolios did what they're supposed to do. Diversification was the way to go. Whereas what we've been, what the market's been concentrating as a result of all these policy changes and, these abnormal conditions in the market. What I hope we're speaking about is the return to normalcy in the market, and then back to the way we used to invest. And I get maybe that's just a dream for 2024, but I think we're due. I think we're due for a normal year. We haven't had one in a long time. So that's what I'm banking on, and I hope we don't have to be talking about all these other things, which would be certainly less positive.
Well, my answer to your answer is amen.
Yeah.
So let's do some quick comments.
Sure.
You've touched on some of these. First one, interest rate outlook.
Yeah. So I know that the consensus forecast calls for lower interest rates, maybe, in the next quarter or so. I don't see it. I would say, I think maybe we get a couple of cuts, but they're going to be very back end loaded. Again, as I said, the Fed stated they wanted to normalize rates. They've normalized them 4 to 5%. That's normal in the historical context. I don't see big changes in interest rates.
Okay, gold.
Gold, I think, could move up a little bit. It's sort of come alive after a decade of being dormant. And, now that we finally poked above the 1800 mark, maybe that raises the upside. That could be due to lingering inflation. And if we get a little bit of easing in interest rates, persistency of inflation, could be a decent recipe for gold.
Okay. And thoughts on currency, and I'll expand that. Canadian, US, Euro, and then you talked about Japan, yen.
Yeah. So I think let's start with Canadian and US. I do think that the Bank of Canada probably needs to lighten rates a little bit more so than the Fed. So that's going to be the big differential. The interest rate differential is going to be the big driver of the currencies. That would suggest a little weakness in the Canadian dollar vis-a-vis the US dollar. Having said that, we've had a pretty good run in the US dollar, a huge run in the US dollar over the last decade, 15 years. If in fact the US begins to lose its dominance in the global scale, the rest of the world weighing on the US dollar, could bode well for the Canadian dollar. But I think from an interest rate differential perspective, I think rates in Canada probably need to come down maybe a little quicker and a little more magnitude than in the US, and that would favor US dollar over Canadian dollar, all else considered. European rates, I think Europe is in a little slower position. Obviously, there's more going on with the conflicts over there, so I don't see a big increase in rates, certainly out of Europe. But if anything, the rate cycle there may be easier than back in the US, and so that would lend further support to the US dollar. Japan, we've been expecting them to change their policy a little bit, which would cause an increase in rates. We haven't seen it, and they've been keeping interest rates low in Japan. So I would say more of the same there, unless there's a need for big policy change in Japan. Let's just assume the Bank of Japan keeps things as is, and maybe steady as we go against the yen, but I don't see big appreciation in the yen in that environment.
Okay, on your answer for Europe, I'm going to split it to pound sterling and euro. Do you see any difference, or do you see the same?
I think the there's a little more negativity around the pound, really more as it relates to policy, potential changes in policy than anything else. And, what we've seen is, of course, we've seen banks and other institutions trying to leave the UK as a result of some of these policies, and that's been weighing on the currency. So that's a tougher call because I also, just given the euro, the various components of the euro and the issues that each of those pieces are going through, make it a tougher call for me, honestly. So I don't have a stronger view one way or the other, pound euro.
Yep, that's fair. That's fair. Reason I ask, of course, is because a lot of expats as clients, a number of them still hold pound sterling, and they're waiting for the glory days to come back before they convert.
Right. Well,
and it hasn't happened for a long time, and I don't see it happening for a long time. So
look, I fully understand it. All of my Canadian assets, I've been waiting for this Canadian dollar to rally, and that hasn't done that for 15 years or something. So it's everybody's waiting. Actually, everybody's waiting for the U.S. dollar to just sort of come down to earth, and the rest of the global currencies appreciate that against that. And I think for that to happen, the U.S. has to be slower than everywhere else, and it just doesn't feel like there's a reason for the U.S. to slow at a faster pace than the rest of the world right now. It just doesn't, maybe someday, but not right now. It doesn't feel
just
that way.
not right now. Yeah. And last one, we touched on it a little bit, but geopolitical risks.
Unfortunately, I fear it gets worse. We're already seeing it. The continued escalation of events in Gaza, and then related all the ancillary events around that. Of course, now the U.S. is dipping their toe a bit more into it, and as they're working on counterattacks in the shipping lanes and trying to protect what's going on there, that's it's just another added element. And the more the U.S. gets involved, the more the retaliation heats up as a result of that. And I just think that leads to more and more conflict. Certainly, the conflict in Ukraine, the war in Ukraine, doesn't seem to be showing any signs of abating anytime soon. And as a result of that, supply constraints and such, you're seeing different formations take place with, between Russia and China. And of course, now you've got the election in Taiwan, and, China pushing back against that a little bit. So it feels to me that things are escalating rather than de-escalating. And that's probably my biggest fear.
Yeah. Well, Bob, I really, really appreciate your insights on the world and global equities, and maybe we'll just call it the world according to Bob. That's normally what they talk about when I start talking, is the world according to John. But I'm off in my own little world a little bit.
Yeah, so we're all off in our own little worlds. That's the way it goes.
Yeah. So thanks so much. Really appreciate you taking the time with our clients.
Well, thanks for having me, John. I appreciate it.
A big thank you to Bob Swanson for being our guest today and giving us his insights on the past, present, and future of global equities. Our next planned podcast is for business owners and managers. It's a process we at Sana Family Office have adopted to drive efficiencies in the running and oversight of our business. And our guest will be Kevin Armstrong, who is our coach. I know that you'll pick up nuggets of wisdom and find what Kevin has to say very useful.
Hi, I'm Trevor Beggs from Sana Family Office, and thanks for listening to John Lawson and the Wealth Wisdom Podcast. Here are the necessary disclosures. Asante Capital Management is a member of the Canadian Investor Protection Fund and Investment Industry Regulatory Organization of Canada. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances. The opinions expressed here are not necessarily those of Asante Capital Management. Thanks again for listening, and we'll catch you next time on the Wealth Wisdom Podcast.